Hey, welcome to Jazz After Dark, everybody. How you doing out there? Hope you had a good weekend, actually. We are financial advisors here at Jazz Wealth. We'll be ourselves if you'll be yourselves and you want to join us here at Jazz Wealth. We'll treat you like family if you decide to join our family. Oh, that was pretty good. I just thought of that. I just came right out. Tonight brought to you by a little bit of Woodford Reserve left over. Now, listen, can you even see that? This is not me. I need you guys to know this. We had a graduation party for my daughter this weekend. And I didn't even have, I had like some blue Kool-Aid looking thing because her colors were blue. And then I come back and I'm in the office here and I'm like, whoa, okay, somebody had a good time. That was not me. Anyways, we are going to talk about the recession here tonight. So is there going to be a recession? If there is, what sort of pullback in the market are you looking for? Because a lot of times people think recession and they think, doom and gloom or like chaos and, things shutting down. And the banks right now, we're seeing some issues there, which are not really the fault of, failure of the financial system. But I can tell that you guys are preparing for a recession. And you're changing your investments in such a way. And the reason we can tell that is because, we track pretty much everything here. We manage our own funds. So it's like we have our own custom ETFs for clients, but they can see inside of everything and participate and stuff. So we do things a little bit differently than other advisors that just buy mutual funds or whatever they do. Because our background is in actually managing mutual funds and ETFs. And so, I like to track, and I'm going to share with you guys this. I like to track, it's a little metric that people use to determine how people are feeling. Recession, not recession, growth in the economy, no growth in the economy. And the way we do that is we compare the ratio, the performance of cyclical stocks that do well in booming markets versus defensive stocks, not defense stocks, defensive stocks. And those tend to do well in recessionary markets, but generally all the time. Think tobacco, grocery stores, sodas, alcohol, your other vices and things like that. We're not going to change, maybe that, we might change the quantity of candy and grocery store shopping and stuff during a recession, but we still have to go. We need toilet paper, we need soaps. So think like that. Whereas cyclical stocks are growth stocks. Oh my God, is there a chance that there's a software company that grows and does really well? Is there an industrial stock that does well, like Caterpillar, because the economy's growing and we're digging more ditches or whatever they do, farming more and things like that. So we compare the two. And basically what happens, I'm going to show you here. So basically when we see the line going up, we know that people are more optimistic. They're willing to invest in cyclical, and they clearly are investing in cyclical type stocks, growth stocks, and good economy type stocks. When the line is going down, people are becoming more defensive, meaning they're moving their money into defensive type stocks, meaning the defensive positions are doing better than the cyclical positions. And this is a really easy way to just have one chart, take a look at it, and you go, people are feeling pretty good, right? The big guys, the institutional money, moving money into growth stocks, or they're moving money more defensively into higher yield staples, consumer staples type stocks. And so what we have going on now is I can see you guys moving money into a defensive position. So much so that if you were to compare just investing defensively, tobacco, consumer staples, things like that, versus your growth stocks, you are outperforming not only the cyclical stocks, but outperforming the stock market itself by 1%. In other words, that much money is shifting over there, causing the buying pressure in defensive stocks to do better than the S&P by about 1%. And so there, in this group that we track here, there's about 1,200 defensive stocks in here. And when I take all 1,212, to be honest, the average gain between all of them, now this is globally, is 11%. There's not 1,200 here in the States. And so we like to, not only see the United States, but of course around the world. Now we can zoom in further and we can actually, you may not be able to read it too much, but this is each individual sector of the S&P. So for example, you might be able to guess that financials performance relative to the S&P is weaker. That doesn't mean financials look like this at the moment. It means that their performance is under that of the S&P, and that's a pretty obvious one right now. If we look at consumer staples, which falls into the defensive category, we can see that that's pretty much where all the excitement is happening, right? In the last couple months, we're pushing, well, and actually throughout the last year, we're pushing higher here, and money is outperforming the S&P. Again, if the line's going up, then we're outperforming the S&P. If the line is going down, we're underperforming. And so we don't see the action in industrials. We don't see so much in energy stocks, material stocks. We do in tech. They're still, gung-ho at the moment. And consumer services is largely tech. Well, not largely, but it's tech these days. Utilities not interested in any of this mix here. And healthcare is slightly outperforming, but we could see it's basically sideways there. So not a lot going on. We can see the action is in consumer staples. So we know, just by looking at 2 slides, that people are preparing for a recession, or at least they want their investments to be in that higher yield category. Now there's a catch. There were, the last 10 years, basically, not counting this year and the last part of last year, the Fed has held interest rates really low. So you couldn't buy a money market fund. You've heard me say this before. You couldn't buy a CD. You couldn't have any kind of bond and expect a return on your money. In fact, after inflation, you were still losing money. And so people would invest in the stock market. So that money was just broadly in the S&P and the NASDAQ looking for growth or whatever yield they could get. At one point, the S&P was the highest yielding product out there. In other words, bonds were yielding less than the S&P. They were yielding less than CDs and money market accounts, etc. And money market funds too. So it forced people to go into the stock market and take that risk. Remember, if you buy a CD, the risk is not there, right? You're insured, and the value of the CD doesn't fluctuate. You're paid your X percentage points, and that's the end of it. In the S&P, at one point, you're getting a 1.78% yield. Remember those days? But you have to deal with the fluctuation of the markets. So the reason I say that is because there's a chance that people are becoming more defensive because it's a higher yielding, meaning they get a higher interest rate or a higher dividend type return. So they know that, look, if I have to invest in Tesla, which doesn't pay a dividend, that's a bad example. If I have to invest in the S&P, which is volatile, to get a small dividend return with the money that I was hoping to be safe, or I can go invest in Pepsi or consumer staples or a consumer staples ETF and use that, then and end up with a 4.4% yield. Well, gee, where am I going to put my money if I want the least amount of volatility for the highest yielding return, assuming we're not talking about bonds and money markets at the moment. So there's a chance that some of that money is just saying, I've been in the stock market this whole time with my late in retirement money, and I don't want that. I worry that there's too much fluctuation. I'm going to move it over here, right? And maybe that's what's going on. But I don't think so. Because if that were the case, then we'd be able to track the ETF fund flows. You've seen me do that before, where we can see the dollar amount going in there and measure that against what's leaving the S&P. While we do have a lot of money leaving the S&P right now for bonds and money markets, that's not shifting just to consumer defensive. There is money that's already in the broad market that's saying, I'd like to stay. I just don't want to be involved in tech as much. I don't want to be involved in consumer discretionary stocks or cyclical stocks as much. So that's how we can tell people are preparing for a recession. Now, the question earlier was, when there is a recession, what do we get? Do we normally get like 50% pullbacks or something scary and the market falls apart? Well, we have very close, actually. 45% was the nasty one that we just experienced. Let's just go over there and see. 2008, if you're old enough and have lived around through that or knew friends, family, parents, whatever that were, well, that was 45%. And that's the low. Intraday, meaning throughout the market's day, we actually pushed lower and bottomed up off of that. But nonetheless, it was a recession, a big one, and we fell 45%. That's an outlier event. Just as 1953 is an outlier event, there was a recession and the market only lost 2%. That's not normal. The median performance is minus 13%. So in any recession, can we live with a 13% pullback as a median return? So more often than not, right? The market's going to do something like that. I think most of you would say yes. However, every time we're leading up to a recession or there's cracks in the economy or the stock market, we think this is the one. Look out, this is the one. We're not coming back from this one. We're never going to grow again. It's kind of normal, right? We think that. We do that here in Florida. When there's a hurricane, we get all kinds of them coming through. But every time one comes, there's inevitably people that go, this is the one. The town is gone. Forget it. You might as well not even board up. Just move on all the way up to Maine or something because this is going to be nasty. Is it the one? For pockets of areas of Florida, it's nasty and unfortunately lots of damage, Fort Myers being the most recent. But did it wipe out the state? Did it wipe out more than like a 17-mile radius area? Less than that, actually? No, everybody else was basically fine. And it's like that in the stock market. So when we look at the recessionary type returns, yeah, it's about minus 13%. Why don't you even round up and say, I don't know, I'd like to play it a little bit worse and say 15 or 20%. Most of us can live with a 20% pullback as long as we're not deep in retirement. Right? If you're deep in retirement, you should have already been adjusting to never, ever have to deal with something like that, even if we have one of these type of drops in the market. So this go around, analysts have predicted if there is a recession, we are going to be at minus 10%. That is their prediction. Largely, mostly congregating right around that 10%. There's not like one guy at minus 1% and one guy at minus 50, right? They're all right there about that 10%. And I tend to agree with that because if we have a recession, we have room, or the Fed has room to manipulate the markets as they do. And I disagree with it, but they'll lower rates and maybe buy some bonds and things. It's what they do. We also have, if you were to follow the S&P's earnings, it's basically over this earnings season. It's basically over, and we were all predicting a minus 7% decline in earnings. We got a 3% decline in earnings. Now, granted, we set the bar really low. Investors set the bar really low, but nonetheless, earnings dropped by 3%. Profit margins haven't really contracted. So the average company in the S&P still has about the same profit margin they had before. However, out of all the companies in the S&P that you're familiar with, Apple or whatever, pick a stock, right? Target, are you paying more or less? Airline tickets, are you paying more or less? Hotels, are you paying more or less? So they're charging more, granted their costs have gone up too, but yet they're making about the same amount of money, meaning the demand is still there from the consumer. So unless that faucet just dries up, we're in pretty good shape for a softer, what they call softer landing in the economy, or a mild, very, very mild recession. Because the consumer is still out there consuming big time. And that could change, but for the moment, there's no layoffs outside of the tech sector that are really, really catastrophic. Now, I'll give you one thing that's a little bit of a kind of a doom and gloomer. Talk to anybody in the trucking industry. I don't know what's going on there. I have a feeling I know what it is, but in the trucking industry, work is getting harder to come by. And workers are starting to take these loads that are not full loads to be able to travel with, and they're doing it for less money because it's more competitive because there's less loads to take, but there's still the same amount of drivers. So you get all these drivers going, I'll take it. And this guy's like, I'll do it for so many cents a mile. And this guy says, I'll do it for a little less cents a mile. So there's something going on there. Now, what I think that is, just to wrap this up, is the fact that during COVID, the shelves were basically empty and we weren't importing stuff as fast as we were. Well, that really sharp rebound after COVID said manufacturers full steam ahead. And we brought all these goods and put them on the shelves. And we still haven't worked through all of them. So I have a feeling that's the case. Imagine You have a boat and you're driving a boat and you go full steam ahead, right? You're like, wow, let's go, let's go, let's go, let's go. The store shelves fill up. You're speeding along, speeding along. Well, even if you pull the brakes back, you're still coasting for a while. And those shelves are getting full and more full and more full, which is good for the consumer. Maybe we'll see some price breaks there for a chance or for a change. Nonetheless, you now have a look into how people are becoming more defensive. Are you? Tell me, leave a comment. I can see them there. Are you becoming more defensive? I would say probably 7 out of 10 clients conservatively that I talk to have done something with either their finances or investments to become just a little more conservative. And a lot of it's moving over to money market accounts. All right, I rambled enough there. I appreciate you hanging out with us. And do us a favor, if you're not a client of Jazz Wealth, I hope you'll consider us. We're a small company, but we're backed by Goldman Sachs. In fact, they invited us to a fancy meeting. I'm kind of excited and a little nervous about it. But if you want an advisor that has nothing, literally nothing to sell but themselves, meaning we perform for you, and if we don't perform for you, we don't grow. Our company can't possibly grow because we don't sell stuff. Fully transparent and all that stuff. And of course, a fiduciary, jazzwealth.com. Appreciate you watching. Have a great rest of your evening.